Let's take a look at an example. Let's create a statement of cash flows for Red Corporation. We see here the balance sheet, the income statement, and then just two pieces of additional information. And we can use this information together to prepare the statement of cash flows. What we're trying to do from a big picture perspective is show cash went from the balance sheet. We can see cash went from 110 million last year to 24 million in the current year. This is a decrease of 86 million of cash. We want to show how did that cash decrease related to operating, investing, and financing activities. Let's start with the operating section. And we're going to use the indirect method in the operating section, where we're going to start with net income, of course, taken from the income statement, and then we're going to make adjustments to get down to cash from operating activities. Net income on the income statement, I see 103 million, so that's my starting point. And then I want to make adjustments for any non-cash expenses. Looking at the income statement, I see depreciation expense of 50 here. If there had been amortization expense, I would include that as well. And we see that depreciation expense reduces net income, but it doesn't have any impact on cash. It's simply something that arises through accrual accounting. So I want to undo that depreciation expense. So I'm going to add it back. I would also add back any losses on sales of long-term assets, intangible assets, plant, property, equipment, marketable securities, but I don't see any gains or losses here. I'm told that equipment was purchased and some equipment was sold, but it was sold at book value. If equipment is sold at book value, that means that there is no gain or loss on the sale. So I have no gains or losses to remove from net income. I've added back my depreciation expense. The next thing I need to do is look at my changes in operating assets. Most of the operating assets are going to be current assets, and I see accounts receivable went from 132 in the prior year to 178 in the most recent year. This is an increase of 46. And when accounts receivable goes up, what that means is that the company had sales on credit. More sales on credit than cash collections. Sales on credit means your net income is higher than your cash from operating activities. And so what we need to do is we need to reduce, subtract out the increase in accounts receivable. So we didn't get this cash revenue. All right, what else do we have here? Prepaid insurance increased by 4. This means we bought prepaid insurance. We purchased more than we used. So cash from operating activities went down for this 4 million that was purchased but not used. It decreased, but there was no impact. If it was not used, then it would not affect the income statement. So we're going to subtract, because we had to pay cash for the prepaid insurance, subtract the increase in prepaid insurance. Inventory is our next current asset. I see that inventory went up 110 million. Okay, so we're going to need to, this presumably was paid in cash. If some of this was on account, for our accounts payable change, we're going to get to that. We're going to adjust for our accounts payable. So right now, it's safe to assume that this was all paid in cash. And what this means is that the cash went down, but the cost of goods sold did not decrease your net income. So cash went down. We need to subtract out the increase in inventory. And once we do adjust for the change in the accounts payable, it won't matter whether or not this assumption is correct that it was paid in cash. All right, so that's it for our operating assets, buildings, and equipment. Changes here are going to go in the investing section. Accounts payable went from 100 to 87. So we had a decrease of 13 million in accounts payable. So this must mean that we paid out more cash than we had expenses. So I need to subtract the increase in accounts payable. Subtract the decrease in accounts payable, which was 13. Accrued liabilities went from 11 to 6, so our accrued liabilities decreased by 5 million. This relates to, we don't know specifically what, but it's probably some combination of salaries payable, interest payable, income taxes payable. That means our expenses were lower than our payments. We paid more, so we need to again subtract the decrease in accrued liabilities of 5. And that's it for our current assets and our current liabilities, or in other words, our operating assets. So we have net income of 103, we add 50, subtract 46, subtract the 4, subtract the 110, subtract the 13, and subtract the 5, and we get to our net cash received or from operating activities of, oh, no, this is a net cash outflow, net cash for operating activities, negative 25. So our expenses and costs were greater than our cash received from customers. Next, let's go to the investing section. Investing, we're looking for changes in our long-term assets. I see just one line here for buildings and equipment, less the accumulated depreciation. The other thing I need to know here is that $230 million of equipment was purchased to replace 180 million of equipment that was 95% depreciated and sold at book value. Okay, so what do we need to do here? Our equipment. We need to know in the investing section. We need to know how much cash was received from the sale of the equipment. We sold some and we purchased some other. And how much cash was paid for purchase of equipment. Well, the purchase of the equipment, it says $230 million was purchased. So we have a cash outflow of 230 million to purchase the equipment, but how much was received from the sale of the equipment? We're not given that exact amount. We have to figure it out. Okay, so we sold 180 million of equipment, but we didn't get 180 million for it. It was 95% depreciated. Okay, so how much was the book value of the equipment? We sold it for its book value. And so what is that book value? Book value is equal to cost minus accumulated depreciation. The cost of the equipment was 180,000, and the accumulated depreciation was 95% of the 180,000. Okay, so 95% of 180 is 171,000. So we have 180,000 minus 171,000. The equipment had a book value of 9,000 and there was no gain or loss on the sale, so we sold it for 9,000. So we received 9, we spent 230 in the investing section. And there was nothing else. So our net cash paid for investing activities is 221 million. And now let's go to the financing section. We want to look for any cash from borrowings, cash for issuance of common stock, purchases of treasury stock, and dividends. So what information do we have here? I see that notes payable increased from 0 to 50. So this increase in notes payable, this is a borrowing, so this would be a financing activity. I see bonds payable went up 160. This would also be a financing activity. No common stock was issued. I don't see anything about treasury stock. And I see information here. In order to maintain the policy of paying cash dividends of 50 million, it was necessary to borrow 50 million from the bank. Okay, so presumably that's the 50 million here that was used to pay dividends. I'm not sure how I feel about borrowing, incurring interest in order to pay dividends, but that's not our job here. Our job here is to put together a statement of cash flows. So we received 50 from notes payable. We received 50, and from the issuance of bonds payable, the bonds payable were 160. And then the only other item that we have is cash paid for dividends. So we have a net cash received from financing activities of 160 million. Now, even though we've, at this point, given the investors everything they need to know, we're still going to finish this little reconciliation here and show the net change in cash. And we're going to add up the sum of what we have in the operating, the investing, and the financing sections. So operating, we had a net cash outflow of 25. Investing, we have a net cash outflow of 221. And financing, we have a net cash inflow of 160. And this is going to give me a net change in cash of a decrease in cash of 86. And that's what I expected, because when I come up to the balance sheet, I see that cash was 110 in the prior year and 24 at the end of this year, which is a decrease of 86. Now we don't stop there. We give the investors the beginning cash balance, which was the prior year's ending cash balance of 110. So below my net change in cash, I'm going to write the beginning cash plus the beginning cash balance of 110, and that gives me my ending cash balance of 24, which is exactly what I have on the balance sheet here.